The final witness that I have the pleasure of introducing is also from Illinois, Mr. Greg Ohlendorf. Greg is President and CEO of First Community Bank and Trust in Beecher, Illinois. First Community Bank and Trust specializes in small business lending, including commercial real estate. Mr. Ohlendorf is testifying on behalf of the Independent Community Bankers of America, where he serves as chairman of their Policy Development Committee. Mr. Ohlendorf, you have 5 minutes to present your testimony.
Chairman Walsh, Ranking Member Schrader, and members of the subcommittee, I'm Greg Ohlendorf, President and CEO of First Community Bank and Trust, a $147 million asset community bank in Beecher, Illinois. I am pleased to be here today to represent the nearly 5,000 members of the Independent Community Bankers of America. Thank you for convening this hearing on the Dodd-Frank Act and its impact on small business lending. Community banks are prodigious small business lenders. In his recent speech before the ICBA annual convention, Federal Reserve Chairman Ben Bernanke shared new research that shows while overall small business lending contracted during the recent recession, lending by a majority of small community banks, those of less than $250 million in assets, actually increased. By contrast, small business lending by the largest banks dropped off sharply. The viability of community banks is linked to the success of our small business customers, and we don't walk away from them when the economy tightens. Community banks have little in common with Wall Street firms, mega banks, or shadow banks. We have a much different risk profile because our business model is built on long-term customer relationships. We cannot succeed without a reputation for fair treatment. We make quality small business loans often passed over by the large banks with their statistical models because of our personal knowledge of the borrower gives us firsthand insight into the true credit quality of a loan. These localized credit decisions made one by thousands of community bankers will restore our economic strength. The Dodd-Frank Act is a generational law and will permanently alter the landscape for financial services. It has proven to be a mixed outcome for community banks, combining both punitive and helpful provisions. Every provider of financial services, including every single community bank, will feel the effects of this new law to some extent. While there are many provisions of the law I could discuss at length, I'll focus my comments on the new CFPB. Community banks are already required to spend significant resources complying with consumer protection rules. This compliance burden is a distraction from our small business lending. Every hour I spend on compliance is an hour that could be spent with a small business customer. CFPB rules should not contribute to this distraction. The CFPB should use its authority to grant broad relief to community banks where appropriate. ICBA also supports legislation recently passed by the Financial Services Committee to reform the CFPB to make it more balanced and accountable in its governance and rule writing. Probably the most frustrating aspect of the current regulatory environment is the trend toward oppressive exams. The misplaced zeal and arbitrary demands of examiners are having a chilling effect on small business lending. Good loan opportunities are passed over for fear of examiner write-downs. I am fortunate in my bank to enjoy a cooperative and constructive working relationship with my regulator, the Federal Reserve Bank of Chicago. Examiners perform a difficult job, and the stakes were raised sharply after the financial crisis, but I believe many examiners have overreacted to the crisis. I've met with hundreds of community bankers from every part of the country in recent years, and I can tell you there's an unmistakable trend toward arbitrary, micromanaged, unreasonably harsh examinations that have the effect of suffocating small business lending. ICBA supports legislation to bring more consistency to the examination process. Arbitrary loan classifications are a particular source of frustration for community bankers. Representative Bill Posey's Common Sense Economic Recovery Act, H.R. 1723, would establish conservative, common-sense criteria for determining when a loan is performing and provide more consistent classification guidance. This bill would give bankers flexibility to work with struggling but viable small business borrowers and help them maintain the capital they need to support their communities. The ICBA-backed Communities First Act, or CFA, H.R. 1697, introduced by Representative Blaine Luchtenmeyer, contains many reforms that would improve the regulatory environment and community bank viability to the benefit of our customers and our communities. To cite just a few examples, CFA would raise the threshold number of bank shareholders that triggers SEC regulation from 500 to 2,000. SEC compliance costs are a significant expense for listed banks. Another provision would extend the 5-year net operating loss carryback provision to free up community bank capital now when it is needed most. We're very pleased that CFA has bipartisan co-sponsorship and look forward to its advancement in the House. Given the state of the private capital markets for small and mid-sized banks, which are largely still frozen since the financial crisis, ICBA supports the Small Business Lending Fund as an alternative source of capital for interested, healthy banks structured to incentivize increased lending. We hope that the first round of capital will be dispersed soon. Thank you again for your commitment to small businesses and your interest in the institutions that partner with them. I've outlined some of the more significant regulatory challenges we face in the months ahead. Thank you for hearing our concerns. We look forward to working with you.